Guru Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB this Tuesday afternoon. I'm Juliette Sarli. Great to have your company as we get towards the pointy end of reporting season. Pretty flat though as we head into match off this Tuesday afternoon. Let's have a look at where the local market is tracking. Virtually unchanged from the open there on the CBO 200, and I'm seeing a similar move coming through on the ASX 200. It's down just 2 points, 9,023. Where we are seeing weakness, no surprise, is coming through in that IT sector, down 3.5%. Still these concerns about AI disruption, the SaaScopocalypse, if you will. I keep trying to say that and not doing it very well. But then, of course, we've had some very good moves in terms of not only precious metals, gold at a 3-week high, but also lithium miners really rallying here. So that has lifted a lot of the materials players when we look at the overall sector. The materials sector up 1.1%, energy up 1.7%. So that gets us to the themes of the day, really about this lithium lift coming through, lifting a lot of the key lithium players. I will point out that PLS and MinRes both up about 7% respectively. So futures for lithium in China climbing after the market reopened following the Lunar New Year break. Video killed the radio star. Unfortunately, I can't take credit for this very clever call, but it was actually from one of the media analysts out there just talking about what we've seen with Southern Cross Media. Of course, we had this merge coming through. It only happened at the beginning of January, and then just hours before the results were due today, Jeff Howard, who had been appointed the CEO of that merged entity, was stood down ahead of those results, which really did show that the Seven Network weighed on the overall numbers there, offsetting some of the gains that you had seen in the radio business, the likes of Triple M. And that was kind of conversely different to what you saw from the Nine Network, which actually came through with an okay profit. It's been helped out, it says, by the Winter Olympics, also married at first sight. And inflation anticipation ahead of the CPI data coming through tomorrow. What that's going to mean, of course, for everybody's favourite betting on what the RBA will do next. Let's have a look at what the lithium stocks did as we round out the session. I mentioned there's some very solid moves coming through from PLS, from MinRes, but have a look as well at Liontown, up 9.5%, and Core Lithium up almost 12%. Media players, having a look at those in the wake of what we saw from Southern Cross Media, down 7.5%. Should point out as well, they've flagged $30 million in cost cutting. News Corp down about 2%, O-Media down 1.5%, as was ARN Media or thereabouts. And IT, of course, coming under pressure once again. Xero there down by 4.4%. Technology One down by 4.3%. Some of the other corporate news we followed today: Woodside Energy, it saw its net profit fall by a quarter for the year amid lower energy prices. Shares though up 3%. We've touched on Southern Cross and also Nine Entertainment there. While elsewhere, we did see that the auto accessories maker ARB plunged on its weak first half earnings, and HMC Capital fell to a new 6-year low on a profit slump. Meanwhile, Scentre Group posted a near 5% rise in funds from operations to $1.19 billion for full year 25. Statutory profit for the period $1.78 billion. I caught up earlier with the CEO, Elliot Rusinoff, after the company came through with what some said actually missed earnings guidance.
2025 was a great year for Scentre Group. As you pointed out, we grew our earnings ahead of guidance. We were able to grow our distributions in line with an upgraded guidance that we announced at the August half year. That was really driven on the back of welcoming 540 million customer visits during the year, spending with our business partners $30 billion of sales on an annualized basis, actual for that 2025 year.
All right, that was Elliot Rusinoff, the CEO of Scentre Group, also just talking about, how to entice people back into the shops, or to the shops, I should say, amid the interest rate hiking cycle that we are going into, amid cost of living pressures. Shopping centres are really becoming like wellness areas where you go, maybe for the free aircon as well, but you go there, you don't just shop, you do a number of things, and you can certainly see that with all the refurbishments they've done. I just wanted to point out as well, ANZ, we didn't have that up on our screen. I think it's pretty flash, but that was quite an interesting move that the former CEO, Shane Elliott, has dropped his case for remuneration against the bank. All right, let's get some more clarity from Martin Crabb from Shaw & Partners. Hello.
Hi Juliet, good to see you.
We're counting down to reporting season. You know, we're going to sleep well this weekend. What have you made of it so far?
It's been better than expected. I mean, obviously the headlines in the big sell-off in not just tech stocks but growth stocks in general, and not an Aussie phenomenon, a global phenomenon, but it's incessant. It's like every day, even if the market opens a little bit better, there's just this incessant selling in the Pro Medicus, the Wisetechs, all these sorts of stocks, just absolutely relentless. And on the flip side, commodities just keep edging higher. BHP all-time high, lithium running pretty hard, gold and silver big bounce last night. So it's just a one-way bet on the Sandfiber up through $20. So just a one-way bet on resources going higher and growth stocks going lower. And it's like, what's the catalyst for this to change? So as a whole, this is just the 12-month forward earnings estimates of all the stocks in the ASX 200, around about $450, you know, back in September, October last year. This big inflection point, that same earnings number now over 500. So that's a 12.5 to 13% uplift in earnings per share expectations. A lot of that is mining, a lot of that's coming from higher commodity prices, but a lot of it's also industrials. I mean, generally speaking, reporting season's been okay. There's been clearly hits and misses, and like intraday volatility's been massive, probably the highest we've ever seen it. But if you look underneath the bonnet, if you like, there's pretty good, solid, like costs are under control, bit of margin expansion, economy's okay, spending's holding up, businesses are executing quite well.
In terms of, you made another good point though, growth stocks really continuing to struggle here.
Yeah.
Is that something that you think is going to continue?
It's hard to say because it does seem to be a train without a station, maybe going in the wrong direction. But we've got our own basket of what we call quality growth stocks. So these are stocks that traditionally have performed very, very well. It's the CSLs, the Macquaries, these sorts of companies, as well as the Wisetechs, Pro Medicuses. And that basket of stocks has underperformed the market in the past 12 months by over 50%. So that's been absolute carnage. Now you can see that historically you get plus 20s and minus 20s out of this group of stocks, with the preferences being on the high side. But yeah, just the last 12 months in particular, and it just seems to be relentless. It almost looks like it's accelerating to the downside. So these stocks do look very, very oversold, and PE ratios have compressed. I mean, Pro Medicus is down, you know, almost a half this month, right? So that's the makeup of that group of stocks. So that if you look through them, there's some particularly successful businesses, Cochlear, you know, Wisetech, ResMed. These are really good businesses globally that have grown, but they've just been under a massive amount of pressure. So is that overdone? It feels like it's overdone, but what's the catalyst for it? The concern is that the market doesn't know how to value the long-term earnings of these businesses if they're going to be disrupted by AI. So, you know, things like medical imaging, things like insurance, things like financial services, if in 5 or 6 years' time your business is being significantly disrupted, what PE do you put on that stock? So the market's massively derated them. Has it gone too far? Arguably it has, but the momentum's all one way, and it takes a very brave investor to catch a falling knife.
It absolutely does. All right, let's get to the macro piece then. We've got inflation tomorrow. What are we expecting?
Yeah, so the market's still looking for sticky inflation. So headline inflation is somewhere around 3.7, which is, you know, a bit of a shock if you're the RBA and you're targeting 2 to 3. If you strip out the top and bottom 15% of items, which is the trimmed mean, that's more like 3.3, but still above where the RBA wants to see it. And the fact that it's sticky and arguably heading upward, there's upward bias on interest rates. So here's the futures curve as of today, the orange line there, and you can see that not much of a chance of a March hike. So if you look at the following contract, which is April, it's not really pricing much of a hike in, maybe 2 or 3 points, so maybe a 10% chance. Excuse me. If you look then beyond the May meeting, the June contract, you're almost at 4.1, so almost a full rate hike being baked in. Then it gets a bit interesting, you know, maybe a chance of another one later this year, but it sort of falls away in 27. So what's the market saying there? there is a chance that the RBA hiked too much and then they got a cut in 2027, which I haven't seen before. That's generally been upward sloping, that line. But just recently, there's just been a little bit of a sort of tail off at the end, which does suggest that maybe there is a risk that they go too high too soon, and we hike rates up to 4.35, and then they have to start cutting them in 27, because that's probably going to cause a bit of a slowdown in the economy.
I mean, that's kind of a reversal of what we saw this year from last year,
exactly.
too, right?
It's almost the complete opposite, yeah.
Oh, how do you make money in that environment then? Well, let's just give a broad view on how you viewed reporting season. I know we've got a couple more days and sometimes the cockroaches come out, but what sort of report card would you give it?
Yeah, well, I think probably a C or a C+. I mean, it's not off to the races like some of the results in America have just blown people out of the water. We did get an incredibly strong result from Monadelphous today, so there has been some real surprises. In the world of continuous disclosure, you probably don't get the beats and misses that you used to get back in the day. But I'd overall give Australia a C, with the mining sector probably getting an A or a B. The mining sector's done very, very well. Some concerns with costs in some of the gold miners, but generally speaking, mining companies have done really well. Pivoted towards industrial metals away from steel making. Precious metals has been a real highlight. So I think generally speaking, the earnings season gets a pass, not like an A+ or an elephant stamp, but it gets a pass. And I think that going forward, most of the guidance statements and the outlook statements were on the positive side. There was a few businesses that said things are getting tougher, but generally speaking, corporate Australia, like you just had the CEO from Scentre Group on, one of the biggest retailers in the country, quite upbeat about the outlook. So not off to the races, but certainly more upbeat, even with interest rate hikes and maybe slower government spending growth. I think the economy is still doing okay.
We used to have a saying at my university, Martin, anything above pass is a waste of drinking time. We might cut that out of the podcast. We're not endorsing drinking here.
No.
Martin, thanks so much. Martin Crabb from Xero
Always a
Partners.
pleasure.
All right, let's get back to what we saw equity-wise. And Martin, of course, touched on Monadelphous, which was the stock of the day. It expects continued demand for its maintenance and construction services, supported by demand in the resources and energy sector. And that was the stock of the day. Francesco Destratus from Ord Minnett, Jonathan Takadina from MPC Markets joined Andrew for their take.
In the right sector, that's growing. You're not going to lose money holding on to this. So it is I would say more of a hold at the moment. If you've got fresh capital, I would wait to enter in. But if you've got it, just lean back and enjoy the ride.
But tempted to just take a bit off the table.
Yeah, absolutely. I mean, it's
in.
just, as I said, and it's just more, I've seen how it reacts at the last two earnings. It does jump and it does go sideways and pulls back a little bit. So that's why I'm saying trim some a little bit here, and there could be a slightly better entry in maybe a month's time.
I would say definitely a hold if you're owning the stock. Would I chase it? I don't know what the EPS is, so it's hard for me to look at see how expensive this stock is. I dare say it'll be trading on a pretty high PE. Whether it justifies all that growth, I struggle to say. But if you own it, I'd hold it. Take a little bit off the table if it's got to a position where it's overweight in your portfolio. I wouldn't be discarding a lightning effect, but as far as buying, look, all those good signs are there. It's just a good company, well managed, good operations, but at what price is a bargain? I don't know, because I don't have those numbers for you.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently.
All right, let's have a look at the after-close leaders on a day where we've finished pretty flat, I should say. We mentioned there that the lithium love, the uptick in futures after China came back on from the Lunar New Year holiday, lifting the likes of Liontown, PLS, very strongly. Aluka Resources, they're up 8%. David Franklin from Argonaut Funds Management telling me earlier that's one of his picks in the rare earths space. And remember that Brazil and India just signed a $28 million free trade agreement to really try and stop Brazil's reliance there on China. Having a look at what we're seeing with the laggards in the space today, this is on the back of reporting season. ARB down 13%, Austral off by about the same amount, SiteMinder, Data3 and Megaport losers as well. In the small end of town, we saw Clearview Wealth have a good session, up by almost 16%, Sovereign Metals there as well, while the laggards in the small end of town included High Pages down by around 14% and Terra Metals off by about 9%. Tonight we get US home prices and the US Conference Board consumer confidence, which is expected to tick up, and earnings season continues as well. You've got the likes of Dr. Pepper, Home Depot, AMC Entertainment, HP, among others. Tomorrow, well, overnight or in the morning, we'll have the State of the Union address from US President Trump. We've also got our inflation data that we talked on. And as we mentioned, reporting season coming to the pointy end, but we've still got the likes of Woolworths, Wisetech, Macquarie Technology and Accent Group all due out tomorrow. Let's recap where the market has finished. It is virtually unchanged there on the CBO 200 and similarly on the ASX 200, which has closed down just 3.7 points to 9,022. And I think if you took out that weakness from some of those REITs, consumer discretionary stocks, and particularly the IT sector, which is down almost 4%, then it would have been a much brighter session. But in terms of where we are at with the overall broader picture, we're about 1% off those record highs that we saw last week. Well, that does it for this Tuesday. We'll be back bright and early from 9:45 a.m. Eastern tomorrow. We'll see you then.